Okay, good evening, ladies and gentlemen. Welcome to our session today. My apologies because of this load shedding. I was only restored around 25 past. We're supposed the schedule was saying 8 o'clock. That's why I told you 8 o'clock, but unfortunately, it has been happening for days now. That will be restored a few minutes later. Very sorry for that. But unfortunately, because of the forthcoming test, I had no option except to make sure that we do the class. Otherwise, I would have said that we're not going to do the class. And also, please check your WhatsApp on Friday and Saturday because I'm going to schedule another class, I think, during the weekend. That will be on Sunday. So I will tell you by Friday, most probably by Friday, because there are some things that I need to understand about some guys who are writing final exams, whom I'm taking for revision classes. So I will understand the schedule, I think, by Friday. Then I'll be able to give you the exact time, but it will be on a Sunday and it will not be in the morning. So if anytime from afternoon Sunday, but I will give you the exact time by um, Sunday, right? And the other week, we'll have a long session during the weekend. I think Saturday or Sunday we'll have a longer session where we'll try to prepare for the test because there are a lot of things that we still need to cover up in terms of PPE and financial instruments. Then furthermore, can you please check your questions because I'm told when I first gave you the first draft of the questions, I'm told that there are some that are different, completely different from those that I sent. So please don't wait for the last minute because you get hold of me on I think it's due on Friday if I'm not mistaken, and then you find that I'm busy and you blame me. Please don't wait for the last minute. So if you've got an issue, I think it's not timed. You can be able to view your questions and see if there are any differences. Then we can discuss if you need help so that I can be able to assist you. But let it happen between tomorrow and Thursday. Please, I don't avoid doing everything on Thursday, on Friday, because you might find that you are trying to get hold of me and then I'm not available, especially Thursday, because I think my Thursday is a little bit flexible than the Wednesday. But some who can be able to get hold of me on Wednesday, we can still try to do that. Right. So please just check if your questions are different so that we can make a plan so that I can assist you. I think you can always go there in there, get all your questions because it's not a timed assessment, and then you see if they are the same. Right. Today we're going to proceed with the property, plant, and equipment. I will go straight to the document. Right. There's a document I will be able to send to you after, which I have here on property, plant, and equipment. I sent you questions. So those questions, those are the ones that we're going to be using. I think maybe during the weekend, because I don't think that we'll be able to use them today. Then today I want to discuss the general things about property, plant, and equipment. Right, property, plant, and equipment is accounted for in terms of IAS 16. So that's IAS 16. And I think we now know that if there is property that is held under a finance lease, we did in the previous topic, that they will not be categorized as PPE, they will be categorized as right of use asset, although the accounting principles are the same as those of PPE. Right. We should know that what is property, plant, and equipment. These are tangible assets that are held for use in the production of goods. For example, machinery and the plant that you use in producing goods. Don't worry about this document. Don't worry about copying this document. What's this document? You're going to get it by tomorrow. Today or tomorrow, you get this document. So don't stress about copying it. Let's concentrate on what I'm saying. Right. Or it can be used for the supply of services. Some entities, they don't produce goods, they can buy computers, which maybe they are providing accounting services, so they use those computers to prepare financial statements for their clients or for rental to others. Right. You can have vehicles that you are renting out, a car rental business. whereby they rent your car and use it, right? But now there is one asset that is for rental, which does not qualify as PP, which is our land and buildings. If we are renting out buildings or land, that will be investment property, which will be accounted for in terms of IAS 40, right? Or you can also use the asset for administrative purposes. So your offices, for example, they are part of property, plant, and equipment. And all these 1 to 4, they should be expected to be used for more than one financial period. So I think basically our property, plant, and equipment are expected to be used for more than one accounting period. So basically, property, plant, and equipment are physical, non-current assets. That is, they are tangible in nature. Those physical, non-current assets that are not investment property. So we're talking about land and buildings. Examples, they land buildings, plant and machinery, motor vehicles, furniture and equipment, aircraft, and ships. And please remember, if the land and buildings are for renting out, they will no longer be qualified as PPE. They will now be investment property. Right. Any questions there on the nature of investment property?
Mr. Eugene.
Yes, my boss.
Please clarify the nature of land and buildings being tangible. Isn't it that they cannot be moved, but they are tangible?
Tangible does not mean immovable.
Oh, okay.
Tangible is just something that is physical in nature, which you can touch, which you can see. That's tangible.
Oh, all right.
So it can be movable or immovable. Right. Then, all right, we move on to measurement. Remember that in all assets that we deal with in our module, there is what we call initial measurement. When we talk about initial measurement, that means the first time when we record it at the first time, at what amount do we record the assets? And we have got what we call subsequent measurement. That is going further after you have already recognized it in your books. Then how do you record it? Actually, before we move on to measurement, there's what we call recognition. For an asset to be recognized as PPE, number one, it should meet the definition of an asset, which we did. That it should be controlled by the entity as a result of past events, and there should be expected future economic benefits. Right. And it should be usable for more than one accounting period. Right. Then it should not be investment property, or what we shall learn, which is called non-current assets held for sale. That is when you have made the decision that you now want to sell your asset. It will no longer be PPE. It will now be what we call a non-current assets held for sale. Right. So when you acquire an asset in the beginning, it is initially recorded at cost. Now, what is cost? Cost, we can look at the purchase price, including import duty and non-refundable taxes after deducting trade discounts. So if you are given discounts, take out those discounts. If there are any non-refundable taxes, for example, VAT, if you are not a VAT vendor. So if you purchase an asset at 800,000, including VAT, and you are not a VAT vendor, you are going to record that asset at 800,000 because that's your cost. Remember, you will not be able to recover the VAT. But for a VAT vendor now, a VAT will be a refundable tax, so they have to deduct it because they will get it back from SARS. That's the difference. Like I was just trying to give light to what is a non-refundable taxi. So that is a taxi that you pay, which you will never recover. They are also included in the cost of the asset. Then any directly attributable costs. Now, when we say direct, please, these things are very important because you find that in your tests and in your assignments, they will bring some costs that are not supposed to be included. And you are supposed to know that this cost is not supposed to be included. This one is supposed to be included. Right. So the following costs that we are going to talk about, they are supposed to be included. Cost of employee benefits arising directly from the acquisition or construction of an item of PPE. For example, if you are constructing a building and some of your employees are working in the construction of the building, their salaries during that period that they are constructing the building will be added to the cost of the asset. Is that right? And please, I know you're doing different modules. Move away from the thinking of MAC 3761, whereby we say maybe if we've got employees who are paid a fixed salary and they are given a job, their cost is irrelevant because it's a committed cost. Here, we don't talk about that. Even if it's a salaried employee who comes and works in the construction or acquisition of an asset, their salaries will be included in the cost of the asset during that period. When we say they'll be included in the cost of an asset, that means they will not be an expense. They'll be part of the cost of the asset. So if you are building, constructing a building, and you pay salaries of 700,000 to employees who are seconded to the construction of the building, that 700,000 will not be taken as an expense in the P&L. It will be added to the cost of that building. Right. Cost of site preparation. For example, you want to mount a plant and equipment, but the place where you want to mount the plant and equipment, it has to be cleared first. It has to be sorted so that the plant and equipment that you are buying can be able to be fitted. So any cost of preparing that site will be part of the cost of the asset. Right. Initial delivery and handling costs. So when you buy an asset, that initial delivery from the beginning. So please note that it's saying initial delivery. So if we're doing other movements, it will no longer be part of the cost of the asset. Then installation and assembly costs. Right. When you are assembling, you also have to include the what? The installation costs. Maybe you hire an expert to do the installation. Those installation costs should be added to the cost of the asset. Right. Testing costs, deduct net proceeds from the sale. Right. What do I mean here? Let me just give an example here. Testing costs. Right. So let's say Eugenius Limited acquired a machine for 500,000. From Zimbabwe, and the company paid import duty of 40,000. Installation cost of 50,000. Right. Then during installation, the machine was tested and testing costs of 35,000 were incurred. Right. 4,500 units, which can be sold at 3 rand per unit, were produced. During the testing process. Right. Determine the cost of the machine. Right. So now we want to calculate this cost of the machine. Right. We have cost of machine. $500,000. We have import duty. Which is 40,000. We have installation costs, which is 50,000. Right. Then we've got testing costs. Now this is the part that I want you to see. So the testing cost would say 35,000. The testing cost, but then we would then subtract the revenue that we're going to get by selling the tested units. So this is what we mean when we say here, testing costs, you deduct the net proceeds from the sale of goods or services produced during testing. So if you produce anything and it is sellable, the net realizable value of those goods, you should deduct them. When we say net realizable value, you can also find that maybe we are going to sell for 3 rand, but they will be selling cost of 1 rand. So you have to deduct again that selling cost if it is there. Right, what do we get? Thank you so much. 21,500. So that will be our cost of the machine. Any questions there? So basically, you include all costs that are incurred to make sure that our asset is usable. All costs that are incurred to ensure that our assets is in a usable condition. Right. Then we also have costs. When we say usable, we mean it's management. We have to decide that now we are happy. Our asset is now available for use. It can now be used. Not the cost up to the day of that it is used. No, but until the day that it is available for use. Available for use and brought to use are different things. For example, you can construct your house and you finish it by August, but you only get in by October. So the moment that it is available, that management are happy that now it's now ready for use, although they are not using it, that's all the costs up to that moment will be, all the direct costs will be added to the cost of the asset. Right. Then this part you should also be very aware of it, my friends. The costs that have to be excluded. Why should you be very, very particular about that part that I was talking about in this one? You'd find that in your exams and tests, they will include costs that have to be included and costs that have to be excluded deliberately. They'll be testing you to see if you know. So you have to know that these costs have to be added to the cost of the asset and these ones do not have to be included. Right, the costs that have to be excluded, cost of opening a new facility. Let's say you buy a new advanced technology machine, then you do an official opening to launch, to show the world what you have done. The cost of opening, whatever you're opening, are not part of the cost of the asset. I think we've seen maybe even the president or ministers opening buildings. That function, all those costs are not part of the cost of the machine. the building or whatever they are launching there. Right. A cost of introducing a new product or service. When you are introducing a new product or service in a particular area, those costs will not be added to the cost of the asset. Cost of conducting business in a new location or with new customer, as well as training costs. Training costs, let's say you buy a machine and you are training the employees on how to use the machine. Whatever training costs, they will not be included in the cost of the asset. Administration and other general overheads, they will not be included unless it's specifically mentioned that they are directly attributable to the acquisition. Right. A cost incurred while in item incapable of operating in the manner intended by management is yet to be brought into use or is operated at less than full capacity. You'd find that when you are starting your business or starting to use an asset, you can start with losses as you try to build up. So those operating losses, they are not part of the cost of the asset. Right. That's also initial operating losses and cost of relocating or reorganizing part or all of the entity. So if you are moving from one location to another, I think those who are doing checks, the moving costs and stuff like that, you should know that the approach is quite different here. So please, you have to know that all these items should not be included in the cost of the asset. Any questions? Right. Then we'll move on to the exchange of PPE items. Right. Sometimes you acquire an asset through exchange. So the question is, what is your cost? We have got about 4 scenarios that we look at when there's an exchange. Number one, if the fair value of both assets can be determined. When we say both assets, that is the asset that you have exchanged in the that you gave the other person and the asset that you obtained. If we can determine their fair values, both of those assets, the cost of the asset will be the fair value of the asset given up. When we say the asset given up is the asset that we have given the other party. Let's say it's me and you. Is that right? I have got a phone. You have a laptop. I like your laptop. You like my phone. Then we decide to exchange. I give you my phone and you give me your laptop. And we can determine the fair values of both assets. Right? To me, my cost will be the phone that I gave you. That's my cost. That's what I paid. And to you, in your books, the cost of the phone that I given you will be the laptop that you gave me. So the cost is what you, the reporting entity, what they paid with, the fair value of what they paid with, not what they obtained. Remember, cost is what you are paying. So let's look at this example. Right, Eugenius Limited exchanged the delivery vehicles with a carrying amount of 300 and a fair value of 320,000 with machinery from Queen Limited with a carrying amount of 400 and a fair value of 370. Right. The cost of the machinery in the books of Eugenius Limited is 320,000. That is the fair value of the what vehicles that they gave Queen Limited. If you are doing the books of Queen Limited, their cost would be 370,000. So your cost is the fair value of the asset that you are giving up to the other party. So in an exam scenario, we have to understand for which entity am I preparing the books. After understanding that, then you check, okay, what have they given up? So that will be the what? The cost of the asset. Any questions on that part? Right. It can happen that the fair value of the asset given up, which you are supposed to use, cannot be determined. But the fair value of the asset that you are obtaining can be determined. I give you my phone, and we can't determine the fair value of my phone because maybe it's not there locally. We don't have such phones. And you give me your laptop, but your laptop, we verify the fair value. He was saying under IAS 16, I was supposed to use the phone that I gave you as the cost. But because we can't determine the fair value, I will then use the fair value of the laptop as the fair value of the asset that you are giving me. So we're saying you take these things in their order. So first of all, check, can I verify the fair values of both products? If they can be verified, then the one that you're giving up is the fair value that you use. Then the second scenario, if the one that you're giving up, you can't determine the fair value. Remember, that's the one that you're supposed to use. Then you use the fair value of what you are obtaining, you are acquiring. Like in this case, Eugenius Limited exchanged the delivery vehicles with a carrying amount of 300,000 with machinery from Queen Limited with a carrying amount of 400,000 and a fair value of 370,000. The fair value of the delivery vehicles is virtually impossible to determine. So that means maybe we don't have a market. We can't we can't find anywhere where they are being traded. So Eugenius were supposed to use the fair value of the vehicles, but it can't be determined. So their cost now, they will use the fair value of the machinery, that is 370. Any questions on that one? Then the third scenario, if the fair values of both assets cannot be determined, that means both assets are of such a nature that you can't determine their fair values. Then in such a scenario, you would use the carrying amount of the asset given up. So you just have to check what was the carrying amount of the asset that I've given up. Right. Just a second. Right. If the fair values of both assets cannot be determined, we said use the carrying amount. For example, Eugenius Limited exchanged their delivery vehicle with a carrying amount of 300 with machinery from Queen with a carrying amount of 400. The fair values of both assets are virtually impossible to determine. The cost of the machinery will be the 300,000. Is that right? Right. Then we've got the last scenario whereby we're saying you can exchange assets without a commercial substance. There is no much difference in the assets exchange. Right. That's when we say there is what? Lack of commercial substance. Now, for example, I exchange my laptop with your laptop. They are exactly the same type of laptop. The only difference being mine is black and yours is silver. But exactly the same, nothing, no difference, no whatever, no difference. And the value of the material used, we assume that is the same. Then you just say, no, I like your black color. They say, no, I also like your silver color. They're in exactly the same state, same condition. They are all Lenovo, same make, same version. Now, such a transaction, they will say that it lacks commercial substance. So when I record your silver laptop, I will just continue recording. I will not make any changes. It will just be assumed that it's just the same asset that is in the books. No changes that will be done. I will just have to go in my asset register and maybe change the the number, the serial numbers and stuff like that. But in the accounting books, we will just record the asset that you obtained as if it was that one that you exchanged. No changes in the records. So as long as you see that there's no commercial substance, there's no value in the transaction, then you continue recording as if it was the old asset. Right. Any questions on exchange of assets? Right. Then we look at subsequent measurement. Subsequent measurement, we are saying, okay, you have recorded initially, you now know the cost of the asset. Then from then on, how do you record that asset in your books? We have got two models that you can use. You can either use the revaluation model or you can use the cost model. You can either use the revaluation or you can use the cost model. Right. When you are using the revaluation model, that means you find someone who is an expert in valuing that asset. Then that person will just come and revalue the asset. And then you change the value of your asset in your books. That is what we call revaluation. Right, but it's required that you should find someone who is qualified. And in your notes to the financial statements, you should state who revalued your assets, and sometimes even the fact that they are a qualified person. Right, that's the revaluation model. Then number two, we can also use the cost model. Actually, in our exams, they are now only testing us on the revaluation of land. Then we can also use what we call the cost model. Now with the cost model, you have to you value asset at cost if it's not land, of course, minus accumulated depreciation on a yearly basis. There's no revaluation of the asset. Those are the two models that we normally use. So it's a question of the company can choose the policy that they want. And we should know that you can also change the policy. Then the provisions of IAS 8 would then come into place. Right. Now, a dismantling cost. Right. Sometimes you can buy an asset, especially these big plants and machinery, but there can be requirement, let's say, for example, according to the Department of Environment, to restore the place where the asset is after usage of the asset. Right. If you buy an asset and you are required to restore the site or dismantle, let's say it's planned, you have to dismantle it at the end of the useful life. The estimate of those costs should be included in the cost of the asset. So an estimate of dismantling, restoring the site should be included in the cost of the asset. But because this dismantling will happen in the future, you have to find the present value of that value. Because maybe you are installing plant and machinery, it will be dismantled after 30 years. And you are going to pay, you estimate that in that 30 years, you are going to pay 50,000. We have to find it. How much is that 50,000 in today's cost? Right. Let's look at an example. Eugenius Limited acquired plant and machinery on 1 January 2023 for 800,000. And this machine is expected to be dismantled at a cost of 200,000 after 8 years. The company's pre-tax discount rate is 10%. Right, to the cost, we take the cost of 800,000, as you can see here. Then we find the present value of this 200,000, this dismantling cost, because this 200,000 will be incurred in 8 years' time, but we need the cost today. So you find the present value, and you use the pre-tax discount rate applied by the company to determine the present value. You'd find that in almost all your exams, they will give you that that rate. But I think by now you should know that as a finance student, there are some rates that you are not given. That you might find that you are in an exam and they need that rate, and you are supposed to know it. For example, you can have an exam whereby they can tell you that the repo rate. I think they've done that in 2 exams so far. They would tell you that the current prime rate, the pre-discount rate is at the current prime rate plus 2%, and they don't tell you in the exam what is the current prime rate. So such things, we have to know what is the current prime rate at the moment. Right. So the FV is 200,000. Our N is 8 because it will be dismantled in 8 years. Our I is 10 because the pre-tax discount rate applied by the company is 10%. Then you find the PV. I think here I made a mistake here. I'm supposed to put this 93. You can use your financial calculator. The present value is 93,301. So although we're going to spend 200,000, but in today's terms, that 200,000 is only worth 93,301. So we only include 93,301. So the cost of the machine will be taken as 893,301. All right, my friends. That estimate is reviewed every year. So it can happen that on 31 December, they review and say it's 250. So we have to adjust our carrying amount. Let's say, for example, the provision, it was 93, isn't it? This was 93. Then by the end of 2023, remember that this acquisition happened on 1 January 2023. So by the end of the year, they will add 10%, because what we're saying, it is 200,000 because of the interest that will happen every year at 10%. So if we add the 10%, the value of the dismantling cost, the provision will be 102,631 at the end of the year, at the current rate. Then we find, okay, after reviewing it to 250, what is the current value? Right. Then you say the future value is 250. Our N is now 7, because this is the end of 2023. 1 year is already gone. So N will be 7. Our I is 10. Then we get 128. So we have to increase the provision from 102 to 128. That increase of 22,658 should be added. Should also be added. I didn't write here. Then this one should be added to the cost of the asset. So when the estimation goes up, you add to the cost of the asset. If it goes down, you subtract from the cost of the asset. Any questions? No questions. Right. Then we'll talk about the cost model. Oh, I wrote here that they will be added to the provision and also the PPE. I wrote that. Right. When we talk about the cost model, right? Let me just include some other things that I need. Just a second. Just give me 1 minute. There are some things that I need to add here before we move on to the questions. Where is this? Mhm. Sorry, just give me a few seconds, few minutes. I just want to, there are things that I need here. All right. Then, right. Right. When we're using the cost model, assets are recorded at carrying amount. And carrying amount is cost minus accumulated depreciation. I think at a later stage, we shall also learn that they can also be what we call impairment of an asset. Right. Then what is depreciation? A depreciation is actually the allocating of the cost of the asset over the useful life of the asset. A actually depreciation, the cost of an asset at the end of the day, it is expensed. But now we cannot just say when we buy a vehicle like it today, then if 100,000, then we take the whole 100,000 and make it an expense for this year. When that vehicle is going to benefit 7 financial years. So according to accounting, we should match the revenue to the income that is obtained. So to match revenue to the income, what we do is we spread the cost of the asset over the years that it will benefit us, it will grant economic benefits. So if our building is going to be used for 20 years, we spread that cost over 20 years. Right. So that allocation of the cost is what we call depreciation. And the depreciable amount of an asset is the cost minus residual value. Right. The residual value, it is the amount that we expect to salvage at the end of the useful life of the asset. Right. Useful life, that is the expected number of years that we expect to use the asset. And if you know that useful life and economic life can be different. Economic life can even be more than the useful life. Because by the time that we say our asset is no longer useful to us, it can be used by someone else. Or maybe we've expanded, we might decide to derecognize it or sell it, but someone else might need it. Right. Then we're going to learn this one. I will do it through questions. Components of an asset can be depreciated separately. For example, we can have, I gave an example there of an aeroplane, which has got an engine which has to be replaced every 5 years. So although the aeroplane has got a useful life of 15 years, the engine only has a useful life of 5 years. So where an asset has got such a component, the asset and the component should be depreciated separately. The aeroplane over 15 years, the engine over 5 years. So although it's one asset, in the books is one asset, but only the calculation of depreciation should be separated. But in the books, it will be recorded in one account. Right, depreciation is also an expense and it is reflected in the profit or loss. But at the same time, the accumulated depreciation will also be deducted from the asset. The difference between depreciation and accumulated depreciation is that depreciation refers to only the depreciation for the current financial year, whereas accumulated depreciation refers to the total depreciation from acquisition up to the current year. So if we bought our asset in 2020 and we are now in 2023, when we say depreciation, we only mean the depreciation of 2023. But accumulated depreciation, we mean all the depreciation from 2020 when we bought the asset until now, 2023. Right. Depreciation, we start providing for depreciation from the date that the asset is available for use. So the moment that I think I talked about that, management are happy that the asset is usable. Although they've not yet started using it, that's when we start to provide for depreciation. And depreciation does not stop when the asset is idle, unless if we are using the units of production method. So if it was during COVID, and then due to a lockdown laws, we are told to close our industry because it's not part of the essential service for 6 months. We'll continue providing for depreciation over those 6 months, unless if we are using the units of production method. The units of production method, it calculates depreciation based on the usage of the asset. Actually, the entity has to determine the best way of providing for depreciation, which should reflect the pattern of consumption of the economic benefits from the asset. Right, depreciation is apportioned if the asset is only available for use for a part of a year. That means if you buy an asset in November or November 1 and your year is ending in December, when you calculate your because depreciation percentages are given per annum, so you have to multiply by the months, maybe let's say 2 months or 2 over 12. So if an asset was only used for part of a year, you should remember that when you are calculating your depreciation, you should take into account the fact that the asset was not used for a whole year. That's what we mean when you say apportioned. So as long as an asset was sold during the year or an asset was bought during the year, you should be very careful to take into account the number of months. Right, I want you at your own time to read on factors that are considered when determining the useful life and factors that are considered when determining the residual value. Right, please guys, remember I said depreciation does not stop when an asset is out idle. We continue providing for depreciation, but when the carrying amount reaches 0, you can no longer depreciate an asset. An asset is not depreciated beyond 0 value. So you depreciate it until the carrying amount can be 0. So even if you are using the asset, but the carrying amount is 0, you don't depreciate it again because you have wholly deducted the cost of the asset. Right, we mainly use 3 methods. There are many methods for depreciation. There are even more than 3, but we only talk about 3 here because those are the ones that we normally use. The straight line method, the reducing or diminishing balance method, and the units of production method. Right, I will look at the 3 methods. Right, the straight line method, a depreciation is the same amount every year. That means the depreciable amount of the asset is spread evenly over the useful life of the asset. we provide the same amount of depreciation every financial year on that particular asset. Right, let's look at an example. Miracles Limited acquired a motor vehicle on 1 August 2017 for 800,000, and this vehicle was available for use as from 31 August 2017. The company's policy is to depreciate, to provide for depreciation using the straight line method at 20%. The financial year ends in December. Right, to calculate our depreciation. In 2017, it will be 20% of 800,000. We then multiply by 4/12. Why? Because it was ready for use on that. I want you to see this. Although we acquired it on 1 August, it was ready for use on 31 August. Although the acquisition happened on what? 1 August. So if you can see, acquisition happened on 1 August, but it was ready for use on 31 August. So we start providing for depreciation from the date that it was available already for use, which is 31 August. And 31 August, if we check our months up to December, we don't include August because it was available on 31. We'll start from September. September to December is 4 months. That's why it's multiplied by 4/12. Then in 2018, it's now a full year. We'll just say 20% times 800,000, which is 160. 2019, the same. 2020, the same. 2021, the same. Then in 2022, it will only be there for 8 months. Remember that if the useful life is, if the depreciation rate is 20%, that means the useful life is 5 years. Where is my 5 coming from? 100% divided by 20%. So that means we'll provide for the same from 1 August until 31 July 20, from 31 August until 31 August 2022. So in the 2022 year, they will only provide up to 31 August 2022, which is 8 months. So they basically use straight line method. In a full year, the depreciation will always be the same: 160, 160, 160. Any questions? Right, diminishing balance method. Right, with the diminishing balance method, the percentage is applied on the carrying amount and not on the cost. According to the proponents of diminishing balance method, they say that you actually use up your asset when it's new. When it's now a score, there's no much depreciation that happens. It will just be slight. So more usage is an asset is more, provides more economic benefits when it's new. Everything, there are examples here. I'm talking about all the examples are there. I think you can see it on your screen, what you're asking. Right. So when we're using the diminishing balance method or reducing balance method, we'll use the same example that we did for 2017. Right, our depreciation in the first year will be 20%, 53. So you find that in the first year, your depreciation, whether you use the first straight line or the diminishing balance, in the first year, the depreciation will be the same. The difference will now come in the second year. Why now? With the reducing balance now, before you apply your percentage, you first have to subtract the depreciation for the previous year, the 53,333. So in 2018, they will say 20% times 800,000 minus 53,033. Then our depreciation will be 149. When they go to 2019, they will then subtract all the accumulated depreciation from the previous years. That is the 53 and the 149 before they calculate the 20%. In 2020, they will subtract again the 53, the 149, and the 119 before they apply the percentage. So what we're saying is, according to the diminishing or reducing balance method, you calculate your depreciation on the percentage times cost. So it will be actually here on the straight line, it will be straight line method depreciation. Is equal to the percentage times cost. Minus residual value. Like the example that I used here, it didn't have residual value. You will see when we do the questions, we'll do examples of the residual value. Right? Or sometimes you are not given the percentage, you are given the number of years. Then if you are given the number of years, you say cost minus residual value divided by number of years. Right, so it's cost minus residual value divided by the number of years. Right. So please, if you are given the number of years, you should do this. Then when we are on the diminishing balance, percentage multiplied by cost minus accumulated depreciation. Minus your residual value. So the main difference is that the diminishing balance subtracts the accumulated depreciation, whereas the straight line does not subtract the accumulated depreciation. Any questions there on the distinction between the straight line and diminishing balance? Right. Then we have the units of production. Right. Units of production measures depreciation based on the productivity of the asset. It determines production based on the productivity of the asset. So you'd find that a depreciation depends on how you have used your asset. Right. So what are we saying here? So we'll have our formula is usage during year multiplied by cost minus residual value over total expected usage. It can be maybe for a vehicle, it can be kilometers traveled. For a machine, it can be number of units produced. It can even be maybe the machine hours that we run the machine. Is that right? So it would depend. So actually, you guys, you don't have to think about which method to use. In your exams, they'll always give you the policy. But they can always ask, for example, these days you see that they ask some theory questions. They can ask you that what are the considerations that have to be taken into account when determining the policy regarding the provision for depreciation. Right. So now let's look at an example. Miracles Limited acquired a motor vehicle on 1 August 2017 for 800,000. And this vehicle was available for use as from 31 August 2017. The company's policy is to provide for depreciation using the units of production method. The financial year ends in December and the vehicle is expected to travel 600,000 kilometers. The vehicle traveled the following during the past years. Right, so you see our depreciation in 2017 will be the usage 150 divided by the total kilometers 600 times our cost 800. If there was a residual value, you could subtract. And now the fact that it was ready for use in August, we don't take it into account when we are using the units of production method. Why? Because depreciation is not dependent on time, it's dependent on usage. So in 1 month, you can use an asset very much. So the depreciation in that month will be too much. So when you're using the units of production method, please remember you don't have to look at the number of months used. Even if you buy an asset during the year or you sell it during the year, you don't have to consider the number of months. Right. Then in 2018, we'll take the usage for 2018, which is 120,000 kilometers divided by 600,000 times 800,000. In 2019, we'll take the usage for 2019, 100,000 divided by 600,000 times 800,000. In 2020, the same, we'll take the 80,000 divided by 600,000 times 800,000. Then in 2021, we'll take the 60,000 divided by 600,000 times 800,000. Right, any questions on that? So those are the methods that we use to provide for depreciation. Right, so as part of your homework, I want you to just go and check. I think I gave you the first one. The first homework, I say you have to go in your study guide and just check the what factors affecting useful life and residual value. And then, okay, it's the and also the theory on revaluation model. Okay, let me just cut this and put it there at the bottom where I want you to go and read on that. Then disclosure requirements. Disclosure requirements. And tax implications. So I want you to look at these things, so that when we meet, we just go to the questions, and then I show you how to do the how to account for the PPE. I will explain these things, of course, but of course the factors I will not explain them. But the revaluation, I will explain it, and the disclosure requirements will do them. The tax implications will do them. But I just want you to go and basically read on what it's all about, so that we save time. Any questions? Okay. So very sorry guys for making you hours, but once in a while expect such things, especially when we're confronting a test in a very short while. If there was no test, I could have said maybe we could postpone, but very sorry for that. We have no option during this period of time. My apologies for that. So please keep the question, and during the weekend we shall have class. I will tell you, but it's likely to be on Sunday, anytime from the afternoon, but I'll give you the date, the exact time by Friday. Thank you so much, and God bless you. Yes, my boss. Yes, my boss.
I just want to check something with regards to the online assessment that is due on Friday.
Yes.
And thank you for that we are offering to assist. So I wanted to check that, because I don't think that you will be available whenever possible. We are making some inquiries about some of the questions. We won't be available immediately to answer us, since it's only having one attempt. So why can't we possibly, but it's a suggestion, to have one platform whereby you'll be able to discuss, I think on Thursday, if but it's just a suggestion, because I don't think it will be possible to answer individually with regards to the question. So I was just suggesting that why can't we maybe have one forum whereby we'll be able to discuss and write the assessment. It's just a suggestion.
Okay, I'll think over it, but even if you're an individual, I was able to assist.
Oh, okay, no problem.
But what we can do, I think that can also help to say maybe we can even do it through the group. If you see a question which is unique, then you can post it, then we can be able to deal with that. That can be fine. I think it's
That
a
can-
very good suggestion.
Okay, so we can use the WhatsApp group, ne?
Yes, I think instead of creating a different platform, maybe let's say by Thursday, you can
Ah.
just post all your questions that are different. Remember that don't worry about going in. What you shouldn't do is to finish only. Is that right?
Yeah.
It's one attempt, but you can leave it open until Friday. So what you do, let's say maybe if you open anytime from the Thursday, or maybe those who are going to arrange maybe tomorrow, then we see how we can be able to answer. Maybe I think that can be a good idea to just post your unique questions. Then if they are answered, just be checking, but don't repeat what has been answered, so that we don't
Yes.
waste time.
Yeah, yeah. Okay, no problem. I think we'll use the WhatsApp group that side.
Yes, my boss.
Okay, thanks, Uche.
Any other questions? Okay, if you don't have any questions, thank you so much, my friends, and very sorry for sleeping this late. But expect once in a while. It will not be every time, but expect something like this once in a while, because almost those modules that have got tests, I might not be able to postpone because of load shedding. Usually, because of exams, my weekends are tight. But if my weekends were flexible, then I could say we could do longer sessions weekend. Okay, thank you so much. So we'll meet weekend. God bless you, Richard.
Thank